right. Well, there we go. It's the midweek update. Joe with you here. It's the 15th of June. More importantly, it is a Fed day. We love Fed days. Let's get into it. I'm going to give you my 2 cents. We'll talk about what to expect, some things to look at. We'll share some trades. Hopefully there's a few. These days are pretty tough because you usually end up sitting on your hands. They are coin flips, but that doesn't mean that trades can't be made, or I should say carried through. So just take responsibility for the outcome. All right, you know how it works. Let's get to our recap. Personally, folks, I've been waiting to talk about this. We've talked about it on Sunday and Monday and Tuesday, but now I get to talk about it. This is the collapse I was looking for. I have talked a lot about I want to see the markets fall apart, they fall off, panic. You've heard me say, hey, the markets are actively selling, the markets are selling off here, but there's no panic. This is the first panic I've seen in these markets, and duly so, as a little bit hotter on the inflation numbers than we expected. We've been talking about peaking inflation, and the Fed seemed pretty comfortable with their 50 basis point raise, but this CPI number came out, and we've discussed this over the last weeks. The consumer's not slowing down. We know that we have inflation. We've talked about this. I go out shopping all the time, and Costco's packed. People are buying new cars, and so I imagine we weren't quite there yet, and even now we might not be. But it's not necessarily a bad thing. The idea was, hey, if the consumer can keep pace with inflation, then we can get what's referred to as a soft landing. The reaction that the markets had from that CPI number on Thursday is not soft. It's not a soft landing. So we collapsed into our first true bear market. We were almost at 20% to the downside. However, the reaction to last week put us there. And then Monday definitely confirmed that we are definitely in that 20% corrective mode. We are in a bear market. So inflation's numbers were unexpectedly expanded from a previous levels. That's, I think, key. Markets expected peaking inflation, and that CPI number broke a 40-year average. Not only we were at 8.3% year over year expected, we went to 8.6. So not only did it stay high, it exceeded a high. And yes, sentiment was absolutely reactionary. It was absolutely bearish. I truly believe the investors are reacting to new data. Rob made a really good statement. I'm not sure if it was Sunday or if it was yesterday's update or 2 days ago's update, but he did say that people have to recalculate. It puts a 50 basis point hike added to this year, and discussion's been going on right now about 0.75% or a 3/4, basis point hike even today. I'll bring that back up in a second. So the crypto instability and fears are growing. This is insult to injury. This is something that's been playing itself out for a while now, quietly. Everybody that I know that owns crypto, that has been trading crypto, are starting to get a little bit uncomfortable. These are also traders of mine or friends of mine that had purchased the Bitcoin in the low 10,000s. So they've seen this before, but to see it drop 60% is unnerving. So we'll see if that continues. The inability for traders to get out. Some of these firms are having a hard time liquidating, so on and so forth. So that's its own problem. And it's usually a snowball effect. And that's when I see panic. It's not just one specific thing. It's something else is going on at the same time, something else going on, and then that last little straw that breaks the camel's back kind of creates a snowball effect. So we'll see if that continues. So inflation hasn't peaked. We can see that in the numbers. Could cause the Fed to be more aggressive. Now, this is the fun thing that I want you guys to kind of mull around. And if you want to make comments, please go ahead and make some comments. I'll read them out loud. This is probably going to be a light day when it comes to trades. The 0.75 basis hike could help these markets bounce. Now, we stalled out. We fell apart Thursday, Friday, and into Monday. And we've stalled out ever since. But an overly aggressive Fed, even a full 100 or a full basis point, right? 100 basis points or a full percent might have an initial hurt reaction, but could be something that knocks this down for a while and creates a rally. So it's going to be interesting on how these markets react. Now, if the Fed comes out and just does a 50 basis point, which they said over the last few months they're going to do, I mean, obviously this CPI number could change things. Does that cause more panic because they're not being more aggressive enough? So it's this really interesting play on what the Fed does and how the market's going to react. I truly believe a full percent increase would create probably bullishness in the short term, but then understand we're still behind the 8 ball and we'll roll over, so on and so forth. A 50 basis point or too light might create bearishness immediately. So it's going to be really fun to watch. I'm kind of looking forward to it. Okay, so got that off my chest. We're excited to go see what happens. Now, trade ideas. I pulled some from last week, a couple trades that have been bouncing around here at Maverick. And it's pretty interesting because I didn't find anything on the bearish side that wasn't already extended. Folks, if you're hopefully in some of these bearish trades already, and if you are, awesome. Just let that register churn and bring it when you're supposed to. On the bull side, I did see a couple things that were quote-unquote hanging in there. So these aren't trades that I want you guys to go buy, but I just think stuff that's hanging in there. One that I thought was interesting was insurance, Lemonade. We'll take a look at it to the sideways because a lot of those insurance companies are almost bear-proof. It's one of those things where you need insurance. So regardless of what happens moving forward, some of these companies can weather the storm. All right, let's just jump into the first. This is USO. Once again, shocker. Oil. Pullback. These aren't ready to buy. None of these are. I just want them on my watch list. Diagonal spreads are still working wonderful on these. I believe we talked about the ascending triangle breakout on 85, and it's working out perfectly if you guys had sold that 90. So it's still strong. I still like it. Sideways to up. It's in the right sector. It's kind of recession proof. It's kind of bearish market proof, so on and so forth. We'll see what happens with energy and oil specifically moving forward. Once again, this isn't something that's coming down. It did actually. The futures have dropped. They're below the 120 mark. I think they were 118 this morning. We'll see how that plays itself out. I'd like to see maybe the Fed tax reduced for a little while. I do believe that here in the U.S. we're talking about maybe pulling more, refining more, getting some more stuff out, just kind of producing more to kind of ease it in the short term. We'll see. But it's still super strong. JD, this is one that I pulled from Rob, and he had a really good, it was pretty interesting to see that these Chinese internet companies are holding in there. And I like to say holding in there. This isn't something that I'm excited to buy, but it didn't correct. It didn't correct nearly as hard as some of the other stuff. And once again, it is overseas. It is its own thing. We'll see how strong China's economy is moving forward. They're coming out of their own problems, but this is just hanging in there. So maybe some food for thought if you guys want to throw some money outside of U.S. and see if you can't gain some strength somewhere else. North Group Grumman, this is it. Industrials, aerospace, and defense. Really interesting how this behaves. What I liked about it is it just seems to do what it does regardless of what the overall markets are doing. This was a massive correction and breakdown in the markets, and if you could see this, guys, it's just the same slope. It's doing pretty good. It's holding in there. All right, and it's a big size stock. It's worth some dollars here. Might be something kind of cool to play range bound or credit spread. See if it can stay above that 460 or 440 mark if you want to open it up wider. Let's be a little bit more flexible on that to see if it can, if it can sustain this move to the upside here. It could be pretty cool. So just areas of strength that are worth raising an eyebrow. Now, folks, if you're like me and you don't want to buy stocks or sell stocks today, it's cool to see how they react. So when I see the markets give up 10% in 2 days, right, 3 days, whatever it is, then I usually go out and say what survived and what got punished. And that can give you a clue on what will happen after the next bounce or consolidation period. So keep that in mind. This is the one that I thought was interesting. Insurance here. It actually moved higher over the last couple of days, and it didn't break below its support level. Let me get my pen out again. Let me draw that support level. Here it is. Right across there. Isn't that interesting? So here's that move. It's moving up today, but then again, so is everything else. Everything else is pretty much flattened out. I do believe after Monday's gap, Tuesday and today, and you'll see the numbers here, folks, we're flat going into this Fed overall from Monday to Wednesday. So anxiously waiting the number. But this is stayed sideways. It's been holding on. So something sideways should be pretty interesting. All right. So that's it. Not a lot today, but we'll go out and we'll take a look at what you guys are looking at. So if you guys want to, please start typing in. Trades, we'll go look at them. And if you don't have any, that's okay. I don't blame you. So let's analyze, I should say, these markets. So far, diamonds, SPQs, flat. Qs actually had a pretty good little bounce today. All three were pretty much flat after Monday's gap down sideways, and then the Qs had a little bit more of a bounce, and same with the Russells. So just up about 1%. Oil and gold are down over 2.5% since Monday. So they're just still tailing off as the rest are kind of hovering around. Now this is, once again, folks, I want to always say it again, this is from Monday to today, to about 15 minutes ago. Now this is definitely changing. So you can see that we're parked. Let's get to the charts and we'll get a little bit more specific into them. So huge fall off, increase in volume. That is exactly what I'd expect. Now the volatility index actually got to resistance levels and it's pulled back ever since. Once again, we're consolidating. I truly believe we get another round of this. I don't know when. I don't know if we get a rally back up to the 390 mark with some good news or whatever the Fed does. The markets seem to like it. We get a relief bounce. That's fine. I truly believe we get another one of these sometime in the future, and I truly believe that VIX spikes much higher than the high 30s. That's, hey, I could be dead wrong. I've seen a lot of markets, and hopefully I am wrong, right? But we'll see for true capitulation. But that really kind of feels like it. It really just depends on the approach the Fed takes and the reaction the markets will give it. However, trading the markets in front of us, which is like we're supposed to do, right? We are at definitely a nice little consolidation point. Had enough momentum and enough fear just to exit, dump positions, and get below that support level, which we did think this was going to be that really cool pivot. We discussed maybe a range through the rest of the summer between that 390, 420 area, and we are definitely below that. Doesn't mean we can't come back. It just depends on, I should say, the status of these markets and their sentiment. Their sentiment. Is there more to go? Are we in for a longer summer when it comes to inflation numbers and a retracting consumer? People starting to maybe not take that vacation anymore because they're worried about gas, so on and so forth. You know how it works. It's pretty interesting too, guys. Let's go to the diamonds. I found a lot of stuff on when it comes to employment. So employment's really good. We're decent. So people have jobs. The unemployment numbers are actually, they ticked up a little bit more claims, but not nearly what you would think. I think the worries are the contraction of the employer, higher costs, less active a consumer. The contraction of the employer has to happen. So we've got to lay some people off. We've got to close some things down. Maybe we don't do as much, don't expand. And that will have an adverse effect in the longer term. We're seeing that in some of these crypto companies like Coinbase. Well, the owner comes out and says, "Hey, we're not going to file bankruptcy. We're fine." But they are firing people. They are laying people off, and they are slowing down quite a bit. So it's a double-edged sword. You have Tesla comes out and they do a 3-for-1 reverse stock split, correct? Or stock split, excuse me, which is usually a worry or a way to generate revenue in an expected downturn. So there's some ominous stuff out there, but it's cool to see, knock on my glass table, that there's no one's getting fired yet or quitting. I think that would be the insult to injury. All right, enough of that. Let's get back to the diamonds here. Also below its support level, the 310 mark, sitting there waiting for the Fed announcement. So we're in a pretty good area. Let's move to the Qs, and I'll show you guys it looks a little bit better because the Qs are, let me see if I can get my slide to move here, have a little bit more of a bounce, but they are definitely below their support level as well. So does the Fed do something that makes these markets relief, just a little bit of a relief? I truly believe this summer is going to be bearish, period. I don't care how you swing it, it's going to be bearish. However, if we get this bounce, it's going to be a Fed move that sentiment agrees with. If it's too aggressive, we might fall apart. If it's not aggressive enough, we might fall apart. If it's expected, maybe we fall apart because it's not aggressive enough. So it's this, they're in a horrible situation. They really can't win right here. However, we just need to follow along with whatever the reaction is. in the market. So let me jump over to the economic numbers. We'll just run through them real quick. Obviously, you guys have seen this. You're watching this all the time. I pulled the PPI out. I pulled the previous and versus. So the PPI actually came in line with expectations. I'm not sure if they increased those expectations from the CPI last week. But look at where it was previously. That's why I wanted it more than doubled. Okay, so this is a real big miss by the Fed when it comes to the consumer price index and the production price index when it comes to inflation. This is way off. These numbers are extremely off. So I think it's already been priced in. I know it's kind of hard to say, did we price it in 3 days? Well, yeah, taking a look at the markets, we're probably pretty darn close to pricing that in. The retail sales, you could see slowed a little bit, 0.5% versus 8. That's a good thing from the reaction if you want to slow the economy down, but right now with inflation still ticking up, that could be worse. Obviously, we know mortgages are going down. We're starting to see home sales come off their highs, right? So we're seeing that happen. So it's all kind of hitting at once. Manufacturing index came in negative again, but not nearly as it was previously. Once again, folks, were expected it to be 3, which is flat, which is not showing any sort of expansion at all. Came from a pretty aggressive contractionary number previously of 11.6. It's down another 1.2. I didn't get the home builders index or the business inventories, folks. I was searching. I couldn't find those numbers. They weren't posted. So I apologize. So we have the FOMC statement, and anything past that doesn't matter. I don't think it's going to make a difference. So that's basically going to drive this whole market for the rest of the week and probably into next month, so on and so forth. It's going to be interesting to see the reaction on whatever the Fed does. So let's launch that poll on the market direction. There it is. And for you folks at home, you guys know how I like to do this. Let's see if I can detach this itself. Oh, there it is. I'm going to carry this over. And this is what our poll looks like. It's very, very small to you, but let's see if I can make it a little bigger. Okay. Oh, there we go. So this is what you get to click on. You know, +2 down to -2. You probably need some 3s in there, I imagine, based on what these are doing. So this is what everybody's taking the poll here. How many people do we have today? It's a little light. Fed days are usually lighter. Add 20. About 20 of you out. Good. Good to see you. Got about 89% voted so far. And these are very difficult. I'd like to maybe do 2 different polls. Maybe like a market direction for the rest of the week and then a longer term market direction. But that'd be very boring for people that don't attend this class because you can't hit the buttons. We'll see. Anyways, whatever your median outlook here is, folks, go ahead and click on it. All right, let me go ahead and move this back because I want to close the poll and share it with you. 94% voted. Thanks, guys. It's pretty good. We had 100% last week. I hadn't seen that in a long time. All right. Cool. Here's the results. So 24% at +1, 24% at 0, 59% -1, 24% at -2. We were definitely on the bear side. 60% almost at -1, 24% -2. That's pretty bearish. Okay, we'll call it a -1.5. How's that? Oh, it's a solid -1 though. I get it. And it could be just the fact that we've kind of flattened out here before the Fed meeting. I don't think that we stay there too long, that's for sure. Thanks, guys, for that. Let me just go ahead and put it back. All right, and hide the poll. Right. I'm thinking a little bit more ominous. Let's see if I can get my slides to go. Definitely -2 on the monthly outlook. I personally could be a little bit more than that. And -2 on the weekly outlook. Do you guys remember the last time the Fed came out? It had a pretty good up day and then it just fell apart, right? The initial reaction looked to be bullish and then it just rolled right over. I'm thinking we do something very similar to that. Or if it's something that the markets don't agree with, we go straight down. Straight down. So I'm at -2 for the week. Then we bounce maybe late this week or early next. But the overall monthly outlook, folks, If you're going to make a mistake and go into a coma for 3 months, make sure it's bearish. Flat out. Well, we might have a huge bounce, we might rally back up, so on and so forth, but this is just the beginning of some serious issues that companies are going to have when it comes to their bottom line. There's no way around it. It doesn't mean it's all doom and gloom. However, it's not looking too good. So we'll see. Yeah, I'm negative too. I'm thinking the reaction, we'll see what it is. Talk to me on Thursday or Friday, and we'll see if that -2 is intact. All right. All right, guys, thank you. Appreciate that. So let's jump into a sector analysis. And as you might have guessed, it's just not good. Everything's to the downside. So what were the biggest loser? Consumer defensive was the strongest. It held in there. Materials was the biggest loser. Excuse me. I just want to make sure we get those. So let's zoom in on this first. And you can see utilities down almost 10%. Big rollover. Materials down 9.8%. That's why it's the biggest loser. The consumer defensive still down over 5%. Now this isn't from Monday. Sorry, folks. This isn't from Monday. I pull this as a weekly outperformance for the sectors themselves. And I like to do that because it's a little bit more generalized, a little bit more smooth, if you will. I want to be more specific when it comes to the overall charts, or I should say the indexes, but not with the sectors. So let's get into it. Here is the consumer defensive, and it's broken down, but it's not as bad. It's not kind of funny to say. It's super bearish. I don't know. There's trying to justify buying anything, but there are some outliers in there that are probably pretty decent. So you just got to go to a specific chart. But overall, folks, it's pretty negative. And then let's jump into materials. Materials just had the most to give. It broke down a little further. Out of all three of the indexes, the diamonds have been getting hurt the worst, and this is a pretty good sell-off. Usually, they've been weathering the storm. It's usually been the Qs and the SPY that's got hurt, but over this last downturn, even with the bounce over the last or today or this consolidation this week, it is definitely the weakest. So here it is, the materials well comfortably below that support of 80, moving sideways. All right, let me do a quick summary, and then we can take a look at what you guys are talking about. So FOMC announcement, that's all it is. Aggressive action could be good for short term. It could cause a bounce. I truly think that a 100 basis point raise, a full percent, or 0.75% shows initiative by the Fed, trying to get ahead of it, because these numbers were way off, and they should have a way off reaction. They really should, and I think it would put confidence back into the Fed and maybe appease the markets. I think the initial move might be down if they did do something super aggressive. However, Thursday, Friday, and going into the next week, I truly think the markets actually come back up due to the fact they're trying to get ahead of this. So your guess is as good as mine. I had to put that in there. Keep your powder dry and wait for your confirmations. There's no reason to try to guess this thing. It's an earnings play. If you guys want to throw a couple of bucks at an earnings play and just go for it and buy the spiders today or short them or whatever you want to do and then push the button at the end of the day, fine. Other than that, let's just keep our powder dry. Let's see where this goes. And if we roll over, it's going to be easier to throw some more dollars at the bears. And if this is going to sustain and bounce, we could play the bounce short term for sure. Sentiment absolutely scrambling to position based on the new data. It really, this number really came out of left field, and the reaction of the markets were as such. So it's still there. There's a lot of worry, a lot of fear, a lot of stuff being pushed and pulled. And I love what Rob said. He's like, you kind of have to throw technicals out here until these markets calm down. A huge capitulation move is I'm expecting a spike into the 40s, somewhere around there. Those you have to stay away from. Volume's high. It's going to bust through all support and resistance levels, so just sit back. So still hot with inflation-bearing numbers, slow down in the manufacturing and consumer. We're not getting that soft landing, obviously, that I was talking about. I think the consumer's going to pretty much clam up and just dry out, and that's it, especially when they see that inflation's not going anywhere. I don't know if we're going to see vacations canceled or anything like that, but maybe rationing your milk and driving less, little things like that, and that does spill over. So there it is. That's enough. Let's jump out and take a look at what you're looking at. Let me get rid of this. There we go. Okay. here we go. So, yep, expected just to kind of consolidate. That's exactly what we're doing. Up 2% in the NASDAQ. Everything's just floating around, waiting for a Fed. Let's stretch this out. Okay, Dan, the first one to it. Looking at Ryan. A July 35-40 bull call spread. Very matter of fact. Range. Okay, range. Look at this. Jeez. Look at that. Let's draw the range first. Okay, I can get behind that. Confirmation of the pivot down here at 34. He's going to play pretty much the meat here between the 35 and the 40 through July. Plenty of time on that. Let me check my calendar here. Oh yeah, geez Louise. Yeah, we got 2.5 weeks till July 2nd. It's the 15th is the third Friday, correct? So you're full 3.5 weeks. That's nice. Sideways to up. Let me write it down. It's a good one. Very good. There we go. Sideways to up. Cool. Thanks, Dan. All right, moving on. Joe's got CTLT. Oops, sorry, CTLT. And we are talking about a bull pullback to the 50 MA, which is also the old resistance for ascending triangle. Okay. Yep. Right there. Love the bull pullback. Confirmation of a pivot. Shoot short-term target of 115. Let me keep reading here. 105, 110 bull call for $2. Sure. He's playing the type point at 105, 110. I'd be fine going all the way to 115 if you guys wanted to. Cool. Okay. Excellent. Thank you. Write that down. CTLT. All right. Very nice. And on that bull call, Joe, I guess it doesn't matter. I mean, take a look at it. If it has weeklies or it's monthlies, it's probably going to be July, right? If not, though, if there are weeklies, you could diagonalize it, play that 15, play the 105, 115. If it doesn't get there, sell the 115 again. If it's got weeklies, I'm not sure, but there's a few things you can do with that. Nice, thanks. Just monthlies, thanks, Joe. It says just monthlies on that. So that might be a little far out. Yeah, your probably best bet is the vertical spread. Awesome. Justin says if you're able to get into the oh yeah, I did. I got into that. I'll take a look at that. But yeah, Justin says he's going to sit back until after the Fed meeting. Thanks for sure. I'll circle round back on that, Justin, for you. SPY. Where would you put next support after closing twice below 380, 350 or 320 or other? Awesome, Scott. Let's just shrink this down. Really just depends on what you want to draw. Let's draw some lines. That's fun. We can draw some lines. We can draw all this stuff. That's pretty tight, isn't it? You could snap a Fibonacci on this thing, too. That might be cool. Well, this is pretty steep. That's a little steeper. Yeah, wow. You know, taking into consider this move, I would like to see a little bit of retracement, but 360, just right off the bat, below 380, probably 360. Scott said 380, 350, or 320. Absolutely, all of those are justifiable. What's really tough about this is I truly think that it's going to be a difficult summer for trading. I think it's going to be a difficult summer for a lot of companies to beat numbers unless they're selling their own stock or something and trying to pad their numbers. We're just not going to have a consumer that's nearly as hard, that was as aggressive as we have been the last 2 years. It's just impossible. But it's difficult to take a 3-day measurement, right? This huge drop from here to here. It's difficult to use that and snap fibos. However, that's how you do it. So if you were to draw something from the previous support at 380 back up to the 420 and then let it extend, yeah, 340, 350, definitely. Shorter term might be 360. It just depends on how fast and aggressive we fall. But Excellent. Thanks for the question, Scott. It's a good question. I would be comfortable extending further than shorter, at least in the short term. And once again, folks, I'm waiting for that capitulation. I want to see the VIX spike comfortably above 40. All right, let's see. All right, Joel, what do you got? Own 2 puts, RSG. Let's take a look at it. 135s. Let me zoom in on this. They expire Friday, but the last couple days I got a bigger move than I thought, so I'm wondering if you think my risk is greater losing to the upside or gaining to the bigger push down. Should I read in the register or hold for the Fed? Now here's what's cool. Joel, you own 2. So Fed meetings cause a lot of emotion and it's tough, and you're sitting with a bird in the hand here, a pretty good one. His question is, do I let this go further? If it's a bad Fed meeting, this will push towards the 120 mark, 115, absolutely. If it's a good, it's going to retain right back up to 130. You're in a tough situation. If you're past your initial target, then the answer should be cut and dry. You should be out of it. If you really want to roll the dice, and Joel, I know that we've worked together quite a bit, taking one off makes total sense. Taking one off makes total sense as well. That way you can let that one go. And if you pull the other one off at 130 and you don't, it might burn a little bit. Or if we get an initial move to the upside, it gets to 127.5, hits this resistance here. Let me just kind of draw through a scenario that might happen. It gets up to this point here, and then it fizzles out, and come Friday, it's on its way back down. It's just, could you sit through a candlestick that does this? Gets up to here and gets down to there and then finishes here. And that's going to be super, super hard to hold on to without pulling a trigger. And let me just tell you, this is why we keep our powder dry. We don't trade these days. I promise you're going to get in or out of this position at the absolute wrong time if you try to do it today. I mean, during the Fed meeting or after it. So, yeah, my advice, Joel, take one off, hit that register, be happy, see what the other one does. But don't do it after the Fed meeting. Do it now, or don't touch it until tomorrow or even the next day, right? Cool. Thanks for sharing that, Joel. I'm sure there's a lot of traders out there in situations like that. Okay. Let's go to KWEB. This is KWeb. Once again, one of these Chinese internet companies. They seem to be doing good. Looking at a 34 June 1724 call calendar spread. Let's see. June 17th, June 24th call calendar spread for 34. Okay. Yeah, I like it. Out of the money, targeting, probably right around there. It's hard. These charts, because of the correction, the moves that these have had, they've really shrank themselves down just to show you how bad things are. Yeah, 34 right there, right at the target. Very nice. Just a week apart, 17th to 24th. Little diagonal shot up there. Sure, let's write it down. These can be kind of tricky to get into and out of, folks. They do gap every day. Have you noticed that? Both JD and this KWeb, they gap up. And so, bid and ask, it's nice to let them play out. Making trades that get all the way to expiration will really help that, make it much easier for you. Okay, let's get to UPS. Another trade James was looking at, sitting in the 180, 172.5. Vertical spread for this week. 180, 72.5. Oh, looks like it wants to give it to you. That's all it needs to do. Looks good. I do like UPS on the bear side. I'd like to see it pivot first. That might come later. So if you guys got on a watch list, or by the time we get to it, if these markets do fall apart, it might be more like the breakdown of a 170. All right, cool. Oh, cool. No risk trades. Those are great. Sitting on a nice profit. Very nice. Yeah, So I was talking about the poll. I got Mesbin and both Matt and Nesbin like, yeah, that'd be great. Yeah, usually the poll that I do is for the week. And most of my traders will click it going from Wednesday to Wednesday. I say, yeah, hey, the rest of the week. And that's why I was thinking about creating another poll. First one would be the monthly outlook. Second would be the long-term outlook. We'll see if we can. Maybe I'll play with it. If it takes up too much time for the class, we'll figure out something. Or I'll just set it, like Matt was just saying, hey, just make it for the month or make it for the week. You know, and then we can go from there. Thanks for the suggestions, though, guys. These are great. Oh, cool. Okay, Sebastian's got some trades on. He said he's played some smaller positions in these. Dell, one that was on the watch list here with us for a while. It seems to be hanging in there pretty good. So, yeah, I like the fact that this has come down and just parked right on this crossing moving average. A lot of strength, showing a lot of outperformance. So that's good. Marriott. Okay. This is decent. We'll see. I like the sideways stuff. Just sit there, right? Just stay right there. You know, don't or rally back up to 160. That's fine. Come up, hit the 160 mark, and then go from there. And then Baba. Yeah, Baba was one that I think Corey was looking at. I believe, or was it on Rob's? I think it was either Corey or Rob. But another one that's just outperforming, and it's just climbed above this quietly. You know, kind of poked its head above, hit resistance at 120, pulled back, got a bullish crossover. Some of these are really doing decent. Chinese internet company, right? They seem to be holding on. So there is some bullish plays out there that are outside of the U.S., but it looks pretty decent. I like it. Okay, what time is it? Oh, we got some time. Okay, this is a trade that we took. I did a live trade on Thursday on McDonald's, right? One that you guys had. So I figured I'm going to start doing some live trade. I'll probably do another one next Thursday. I think we're going to do it twice a week. I think Corey put one on yesterday as well. So we're going to just do a lot more activity like that. It's a lot of fun. Oh, looks like I've got to carry out this thing at 235. So I wanted to take some of my trade off at the 235. It's a targeted butterfly, 240, 235, 230. Didn't get to it 2 days ago on Monday. My rule is it's got to be midday. It's got to be midday, and if it's the point, I'll take it. I don't like playing volatility in the morning or in the afternoon. Didn't look so good yesterday. Looks pretty decent today. This could flip-flop. If it goes up to 245 tomorrow or this afternoon, I don't care. If it starts to roll through the 235 mark, that might be something where I'll probably take at least a third off. If it's a really aggressive and it's kind of falling apart, I might take 2/3 off and then let the rest go to expiration, which is only Friday. So it's looking pretty decent. I think I'm sitting in a small profit right now, a few $100. So yeah, kind of a fun little trade, that 235 target. All right, well that's it. Let's go. Let's see. You guys can take a look at this. Let me read a little comment Scott put in here. Maybe we should start each week, prior week average forecast response numbers. Yeah. Wednesday to Friday's close. Okay, yeah. It's not a bad idea. So what Scott's saying is like we could just take a look at the SPY as a percentage. That will be our vote of from Wednesday to Friday's close. I like that, from close to close. That might be something just kind of shorter term, because I know that our Sunday class is Monday to Friday. They have that ability. Midweek is midweek. So I keep saying Wednesday to Friday or Wednesday to Wednesday. I'm not sure which one to look at. Or do we just go month outlook? I will play with it. Thanks for the suggestions, folks. Okay, so here is, you're just staring at the markets. And I believe that's what you're looking at. So, yeah, we'll see. I imagine they just kind of park sideways here until the Fed comes out, makes their decision. Let's see what happens. It'll be interesting. We'll probably take off to the upside or take off to the downside and retrace, and I'll play that game. So it'll be interesting to see how aggressive they are and how the market, more importantly, how the market absorbs it. All right, guys, that's awesome. Thank you so much for the participation. These are tough sometimes, so but to have a couple of trades to look at is awesome. In fact, before I cut you loose, let me type them in. There was only 3. Yeah, let me go ahead and type them in, and then I'll share it real quick, and we'll cut you loose. All right, so what were they? Ryan. Okay, and CTLT, all on the bull side too. And then Sebastian had some other ones but understand, folks, these are the ones that were already out. They were suggested on the Sunday class, so review that if you'd like. Let's do from a current slide. There they are. Cool. Just a few. I did like Ryan sideways as well, so if you guys wanted to play something sideways on that, that's pretty cool. Sideways to up is what that was. But decent. All right, guys. Thanks so much. And we'll see you next time. Bye, everybody.